Everywhere you turn right now, headlines, podcasts, YouTube, everyone's talking about interest rates, but almost no one is explaining what it actually means for real estate investors and especially for retail shopping center investors. So today, I'm going to break down how the rising rates have impacted valuations, our strategies, and where some of the smartest opportunities are right now in the retail real estate space. So let's dive into how interest rates affect retail real estate, retail shopping center investment strategies. We've been in I wouldn't say it's a rising interest rate environment now, but it's kind of higher for longer. But how does this affect our viewpoint? Who's in the market? Who's not? Let's go through some of the different strategies, the higher rates versus cap rates versus the type of investors that we're going to have. So how rising rates impact retail property values. Typically, as interest rates rise, cap rates will rise as well. Cap rates expand. And the reason for this is investors are demanding higher returns to compensate for more expensive debt. Interest rates typically affect the debt markets, right? Where your loan is going to be a higher interest rate, which means higher payments, et cetera, et cetera. So we need to buy the properties for cheaper, therefore a higher cap rate. So again, as interest rates rise, cap rates tend to rise as well. And this causes property values to decrease. So an example would be a property that typically traded at like a 6% cap rate might now need to trade closer to a 7% or higher to attract buyers because they're looking at getting the return as well. Whether or not that buyer ask bid is closing or not is a whole different question. But when your cost of capital rises, the deal needs to cash flow harder or sellers need to drop their prices. Usually both of these will happen over time. So the buyer-seller disconnect typically happens fast. So sellers are often the slowest to adjust pricing in a rising rate environment. We are just seeing this higher interest rate environment over the last few years now, and we are starting to see some deals come back to the table that maybe have fallen out of escrow in previous years or previous months because of this scenario of the cost of capital is more expensive. Buyers will immediately adjust their underwriting to reflect these higher debt costs, right? So results is fewer transactions, longer time on the market that we're seeing right now, and more negotiating leverage for the buyers. So this is where the opportunity starts to show up for buyers who stay patient and stay disciplined and wait for these sellers to come back to reality. What else happens in a higher interest rate environment? We typically see that the shift in buyer profiles during higher interest rate environments changes drastically. You get a lot of the institutional capital, which will pull back fast. These funds, large institutional funds, thinking private equity, some family offices, thinking insurance companies, pension funds, etc., are extremely interest rate sensitive and rely on cheap debt to hit their minimum return targets, right? So when interest rates rise, these type of institutional buyers often pause or they'll reprice deals aggressively to try to hit their return metrics that they need to hit. So when these big players step back, it creates a massive opportunity for private investors, for syndicators like us, and more of the mom and pop type buyers to really get in there and make a showing. Who also wins in this are cash buyers, right? Makes kind of sense. When your debt's super expensive, cash kind of becomes the king. And another thing that really we see an uptick on is 1031 exchange buyers. Seem to dominate the higher interest rate, have been really dominating the last couple of years here. So as cash and low leverage buyers become more competitive because they're less exposed to debt risks, right? They're putting more cash down, safer. So when interest rates are rising or they're kind of stuck at a higher level for longer, the cash and lower leverage buyers are typically coming out on top. And 1031 buyers, can go into a whole podcast here on 1031 and what that all means. It's a whole subject in itself, but they are typically under a tight timeline to deploy capital, typically sold out of a different type of or a different deal, and they will need to deploy capital within a certain amount of time. So even if rates are high, they are looking at it through a different lens than a lot of other investors. It's all due to tax and avoiding capital gains tax. So in today's market, cash flow beats cheap debt. And that's a huge mindset shift from years ago. Cash on cash becomes king. So investors will prioritize actual cash distributions over their projected, say, 5-year IRR driven models. Immediate cash flow carries more weight than speculative future exits. So right now it's all about buying assets that try to pay you today and not just betting on the sale or betting on appreciation into the future. It's a hard thing to do when a rising interest rate environment or a little bit of an unknown environment, and when cap rates are rising, valuations are typically going to become lower. So we're looking more at cash flow and we're looking more at what can produce revenue now, what makes sense now. It really tightens up the underwriting starting to look at it through a much more conservative lens. Another item, something that becomes extremely important, is your debt strategy becomes the critical variable. So think of fixed rate versus floating rate debt, looking at all of these different options, getting creative when we're in a higher interest rate environment here. So fixed rate versus floating rate debt, fixed rate loans, usually a little bit more stability, often stricter terms and lower leverage in today's market, or floating rate loans offer a little more flexibility, but they're higher risk if interest rates climb. You can buy interest cap insurance and things to kind of mitigate that risk, but good to go variable interest rate in a declining market, which we hope we're in, but we still don't know. To grab something like that a couple of years ago as things were increasing, highly risky, need to be careful with that. So choosing the wrong debt structure could wipe out your deal before you even get started. So want to be mindful of this. Something that we see a lot of the lenders coming back with, especially in today's market, which is making deals harder to pencil, is higher debt service coverage ratios. Typically, we're seeing some of the lenders come back somewhere in the 1.35. So that means your asset needs to be cash flowing 1.35x above what the loan payment would be. And they're doing this, it's to be conservative. So it's not just about buying anymore. It's about how to finance and smartly underwrite under these tighter lending requirements. Who wins in this equation? Moderate leverage. Like we mentioned, cash buyers, people that are kind of forced to go out there and put their money somewhere. But typically these 60 to 65% leverage deals are much safer today than trying to squeeze the 80 to 85%, even 90% that we saw in 2021. The great thing about retail is we didn't have a lot of that type of deal structure early on. We didn't see the multifamily boom right before COVID. So we've always had kind of conservatively underwritten deals with strong in-place cash flow, which is why we're doing well and we don't have a lot of the distress in the retail real estate market as we've seen in multifamily and whatnot. Discipline beats aggression every time, especially in today's market. Why is retail, especially necessity-based, convenience-based retail centers, holding up better? Good question. We have sticky tenants, which equals stable cash flow, right? These are what we like to say recession-proof, convenience-based retail centers. You think of grocery stores, medical offices, fitness centers, nail salons. People need to eat. People need to shop. They need to get their dentist. They need to be in a physical location to get some of these. So these businesses are typically resilient during economic slowdowns. So people might cut back on vacations, but they're not canceling out the dentist or the doctor visit or the grocery store or that coffee addiction that they have. And that's why they're jumping into convenience-based retail. That's what we've seen really shine out of the pandemic, especially when people were locked down. These were the items that they still needed to go and pick up food or have it delivered, but need to be made somewhere. Another reason that necessity-based retail is doing well in a higher interest rate environment is we have what's called triple net leases, which these shield the owners from rising costs that you would typically see in multifamily asset or an office asset or even industrial that's not triple net, where we're passing on tenants paying taxes, insurance, maintenance expenses. So these rising operating costs don't erode our landlord income the way that we see in multifamily or office. So as inflation hits, triple net landlords, we sleep a little bit easier than multifamily owners who absorb all of those rising costs directly. We also, in these, because we're signing long-term leases, minimum of 3-5 years, all the way up 7-10 with a couple even 5-year options. I mean, these are 20-year leases potentially with built-in rent escalations, which offer kind of a natural inflation protection. So many of these retail leases have 2 to 3% annual increases already baked in at set periods of time, whether it's annually or every couple of years. Quite honestly, I would even try for more than that. I've seen a few centers around, especially when there's lesser credit in the center or the tenant is lesser credit, more of a mom and pop or local or regional tenant. I would try to get something more in the 4% a year. I see that really underwrites well. That's something that you could cap out. So some leases even allow for what we call expense pass-throughs. So this is further protecting some of those income streams. Good leases are like a rising tide for your cash flow, even when rates are climbing. That's what we are benefiting from during these high interest rate times. Some of this stuff was negotiated years back before we got into this environment, but there was a little bit of protection there. And again, we don't have the headwinds coming or distressed in retail. We do from vacancies, but we don't have them from super high leveraged loans that went out for retail that are now coming due, like you see in multifamily or even. So where are these new opportunities coming from? So new opportunities created by this higher interest rate environment. We're starting to see motivated sellers finally willing to negotiate. Maybe they were over leveraged. Maybe they did have some kind of lower interest. maybe interest only type loans. That could be a possibility that we're seeing. So some of these over leveraged are facing some refinancing challenges, developers who missed their exit windows, and we're seeing a lot of sellers willing to do price reductions, seller carrybacks, or creative financing. Seller carryback being seller financing, especially if something's paid off, or we could assume a loan, a lower interest loan that was purchased during COVID period and during our kind of zero interest rate environment. So a lot of distress doesn't necessarily look like bankruptcy. It looks quiet. It looks like price drops. It looks like creative deal making. It looks like sellers coming back to the table. It's not making the headlines like this big wave of distressed retail coming out or big properties that we were hoping to all see. It's looking a lot more like sellers just willing to do something to get a deal done. We've got a couple of deals right now that we're looking at. We're at the table with seller financing options and whatnot, which is extremely attractive right now. And it's really a win-win. Whole nother topic as well. But seller financing has massive benefits for really both parties. For the buyer, not having to deal with the bank and lenders and going through that entire big headache as anyone's purchased a home or anything, knows that lenders are difficult to work with. That helps on the buyer side. Sellers then are avoiding some capital gains. They're getting a monthly payment in lieu of just a massive upfront capital that if they don't deploy that into something else, aka 1031 exchange, they are looking at big capital gains, tax. There's a whole topic there. So really buying at today's higher cap rates is building in tomorrow's upsides. Cap rates have already been adjusted. Finally, we're seeing some of this being adjusted. Pricing and cap rates kind of realigning in many submarkets. So when interest rates eventually do stabilize or hopefully come down, some of the assets that were purchased today, we could see some instant value boost. Remember, cap rates come down, property values typically will go up. Cost of capital becomes cheaper. So the best deals really aren't made in boom times. They're made when everyone else is confused. When no one else is buying or building, might be the best time to do so. Kind of like the Warren Buffett quote, when everyone else is fearful, I'm greedy. And when everyone is greedy, I'm fearful. And right now, we are extremely bullish on retail centers. We're extremely bullish on commercial real estate. In general, we love these neighborhood centers. We think that this convenience-based retail has a lot of room to run. They're not building anymore, so it is prime for redevelopment right now. Let's go ahead and sum this up a little bit. Higher rates have made the real estate game harder. It's really not about just buying right. It's about operating the center well, adding value, and has really kind of made the operators really become operators again and not just be able to purchase with the hopes for appreciation in the near-term future. You've really got to look at this. How do we reduce expenses? How do we curate the right tenant mix to boost rents and make sure that the entire center is thriving? Investors who understand today's debt market and tenant fundamentals can really find incredible deals out there right now. And like I keep saying, retail, especially this necessity, convenience-based, retail, service-driven centers offers protection and stability and upside right now. Even if we were to get into a recessionary environment, I think that we would have a little bit of a safety net or be able to weather a storm with conservative underwriting, with necessity-based retail. And here at West Hive Capital, that's exactly the niche that we're investing into. So if you guys are interested in learning more about retail investing, more about the strategy and how to underwrite, drop us a note in the comments here. Happy to hear topics that you guys would like to hear about. If you have questions about structuring deals, underwriting in today's market, drop them below, visit our website. Love to hear from you guys. Thank you.